Hello, I am Alessandra Garcia together with Nicole Bundok, and we are here to discuss the corporate taxation in Italy in a broader sense of understanding. Here are the topics that we will be tackling in this session. And let's start with the significant developments in corporate taxation in Italy. So here are the approval of several corporate income tax provision in Italy Decree Law by 2004. Italian corporate entities are subject to a corporate income tax known as Imposta sul Reddito Soli Societe or IRIS and to a regional production tax known as Imposta Regionale Soli Attività Produttiva or IRAP. Here, the deadlines of the filing to their tax returns are usually at the last day of the ninth month in the tax period. The notional interest deduction is revoked for allowing the corporate the use of any surplus credits from previous periods until exhausted. Ang mga kumpanyang kumukuha ng permanenteng empleyado ay makikinabang sa ilang partikular na kondisyon ng 20% na pagtaas sa bawat sa gastos ng mga empleyado. Capital gains realized by European Union or European Economic Area, companies and entities without a permanent establishment in Italy are subject to taxations on only 5% of their amount. Ito ay dahil na rin sa pagrespeto sa sale of qualified participations at sa mga may PEX or extensions of participation exemption requirements. And also, the offsetting of tax credits in Italy is prevented in case of expired rolls or executive tax assessment exceeding 100,000 euro. Depending approval from the European Commission, a proposed 50% reduction in corporate income tax and IRAP tax is allowed for business and professional income transferred to Italy from non-European Union or European Economic Area country for at least 6 fiscal year. At ang enhancement of tax control framework and cooperative compliance regime naman ay para sa cooperative compliance regime na binibigyan ng karagdagang katiyakan sa mga nagbabayad ng buwis na nagnanais na mamuhunin sa transparency towards tax authority na may significant reduction of the assessment terms and enhanced reward in terms of penalty regime, and the introduction of several VAT and other tax provisions falls down with the increase in the VAT rate from 5% to 10% for child products and female hygiene protection, and 22% naman para sa mga child seats na nai-install sa motor vehicles. Second, payment of VAT in case of the elimination of stock for entities adopting Italian GAAP. And lastly, the tax on the consumption on single-use manufactured goods or plastic tax and on sweetened soft drinks, or also known as the sugar tax, is also introduced to taxes provisions in July 1, 2024. Tax credits and incentives. Ito naman na ay yung mga provision na lately na-approved in tax credits and incentives in their corporate taxation. From January 1, 2024, the maximum amount of de minimis aid per single undertaking is increased to 300,000 euro over 3 years. And an obligation is introduced for companies with legal headquarters in Italy or having legal headquarters abroad with a permanent establishment in Italy arrange catastrophic risk insurance by December 31 and 2024. Non-compliance may lead to adverse consequences concerning requests for public incentives.
So now, let's talk about the taxes on corporate income. Italian corporate entities are subject to a corporate income tax known as Imposta sul Reddito sul Società or IRES and to a regional production tax known as Imposta Regional sul Attività Produttive or IRAP. The standard rates are as follows: 24% for IRES and 3.9% for IRAP. Now, let's proceed with their general rules. For IRS, the IRS taxable base is determined according to the worldwide taxation principle, which states that regardless of the location or jurisdiction where the income is produced, to the extent that the income is legally attributable to an Italian resident entity, the income is taxed in Italy. IRS is charged on the total net income reported in the financial statements of the company as adjusted for specific tax rules. Please note that non-resident companies are taxed only on Italian source income. For IRAP, there are different methods of computation for the IRAP taxable base, depending on the nature of the business carried out by the taxpayer. Provisions for liabilities and risk, as well as extraordinary items, cannot be taken into account when determining the IRAP taxable base. For banks, the IRAP taxable base is broadly defined as follows: intermediation margin reduced by 50% of dividends, 90% of amortization costs relating to fixed tangible and intangible assets, 90% of other administrative expenses, and net value of adjustments and reassessments for bad debts. The deduction of labor costs for IRAP purposes depends on the type of hiring contract. In particular, first, full deduction for costs related to employees hired with an open-ended contract. And next, deduction limited to contributions for compulsory insurance against accidents for temporary employees. Next is the substitutive tax on reorganizations, mergers, demergers, and contributions in kind. The substitutive tax is calculated by the step up in tax basis and is based on progressive rates of 12% to 16%, um, to be paid by the deadline of the tax payment of the fiscal year in which the reorganization took place or the following fiscal year. The substitutive tax may also be paid in three annual installments of 30% in the year of election, 40% in year 2, and 30% in year 3, plus interest at the rate of 2.5% per year on the deferred amounts. The substitutive tax is not deductible for the purpose of IRS or IRA. Next is the free step-up on reorganizations. Under certain conditions, a free step-up of the tax basis of capital assets in case of mergers, demergers, and contributions in kind is granted up to 5 million euros. The law provides for a free tax step-up regime for both corporate and regional tax purposes for companies receiving assets upon mergers, demergers, or contributions in kind which takes place between May 1, 2019 and December 31, 2022. That means that the increased accounting value of goodwill, tangible assets, and intangible assets accounted for by the receiving entity will be recognized for tax purposes. The benefit applies to mergers, demergers, and contributions in kind that occur between companies not belonging to the same group and under the condition that such entities carried out their business activity for at least 2 years. Next is tonnage tax. To qualify for tonnage tax, ships must first have a net tonnage of more than 100 net tons. Second, be used for goods transportation, passenger transportation, salvage, towing, and other services. Third, operate in international shipping as defined by the rules disciplining Italian International Registry. Ships chartered out on a bareboat charter are excluded. Chartered ships with crew are included in the tonnage tax regime if the global net tonnage is less than 50% of the total net tonnage. Tonnage income is calculated on the basis of the ship's net tonnage. The daily income is determined according to the following rate system. So for 0 to 1,000 ships net tonnage, ang daily income nila in euro per net ton is 0.0090. While 1,001 to 10,000, ang daily income in euro per net ton ay 0.0070. While 10,001 to 25,000, ang daily income in euro per NT nila ay 0.0040. And of course, above 25,001, ang daily income in euro per net ton naman nila ay 0.020. Days in which the ships are not in use due to maintenance operation or are temporarily out of commission are not to be taken into consideration. Income and expenses from the following activities are all deemed to be covered by the tonnage income determined as previously discussed, such as transport of goods, transport of passengers, salvage and towing, other services that need to be performed on the high seas, charges related to the above mentioned activities, other operations performed in close connection with the transportation operations, and of course, other minor activities.
The criteria according to which tax residence is recognized on the basis of the principal business activity has been eliminated. And from that time, ang mga kumpanya at entities na na-consider as resident in Italy, kung meron pa silang territory of the state for the greater part of the tax period, either they have their legal office, the place of effective management, which is the place where the company's strategic decisions are made, and their principal place of ordinary management, which is the place where acts of day-by-day management are carried out. At ang mga foreign company naman that are holding one of or more Italian subsidiaries is deemed to be resident in Italy for tax purposes if at least they have one of these qualifications, which are the foreign company is either directly or indirectly held by Italian tax resident person. Second is that the board of directors of the foreign company is made up mainly of Italian resident individuals. Non-resident companies are subject to IRS and IRA only under Italian source income. Specifically, Italian non-resident companies having a PE in Italy are subject to IRS and IRA with respect to the taxable income generated from the PE in Italy.
So now let's proceed with other taxes. First in line, VAT. Italian VAT or Imposta sul Valor Agguento applies to the supply of goods and services carried out in Italy by entrepreneurs, professionals, or artists and on importations carried out by anyone. Intra-community acquisitions are also subject to VAT under certain conditions. These certain conditions include the following, but I won't mention it anymore. Now, let's proceed with the solidarity contribution on the energy sector. The 2023 budget law introduced a temporary solidarity contribution for the year 2023 due by the enterprises with activities in the energy and oil and gas sector due to the extraordinary increase in prices in this sector. Please note that specific provisions are introduced to determine the taxable basis of the solidarity contribution. Next, the registration tax. Specific deeds and contracts must be filed with the local registration tax office either upon signature of or if specific circumstances occur, and the relevant tax must be paid. Depending on the nature of the contract and on the assets that are object of the contract, as well as on the form of the contract, registration tax is levied as a fixed amount or as a percentage of the value of the goods and or rights that are the object of the contract. Note again that as a general rule, no proportional registration tax is due in the case of transactions subject to VAT. Next is the VAT and registration tax on lease of immovable properties. Here, leases of residential and commercial buildings or portions thereof generally are exempt from VAT with no right to deduction and subject to the registration tax of 2% or 1% rate. Next is the custom duties. The amount of custom duties to pay depends on the value and nature of the goods imported. In particular, for each kind of good, the common customs tariff provides a tax rate to be applied to the value or number of goods imported. The correct classification of the goods is one of the most important issues to consider when an economic operator introduces goods in Italy. A wrong classification can give rise to the application of higher custom duties and the operator could face a tax burden not due or to the application of lower customs duties. And this situation could lead to a tax assessment by the Italian Customs Authority. Next is the re-engineering of the electronic important clearance system. As of November 30, 2022, the Italian Customs Authority, as part of the re-engineering project of the electronic import clearance system, announced the definitive dismissal of the IM message in favor of the new telematic tracks for the transmission of the import custom declarations. Next is the excise duties. The following goods are subject to excise duties: energetic products such as petrol, gas, oil, natural gas, or coal; alcohol and alcoholic drinks such as wine, beer, or ethylic alcohol; processed tobaccos like cigars, cigarettes, or tobacco; and electronic power. Moreover, the tax liability depending on the products arises: first, at the moment of importation of the production, or second, when the excisable goods are used for heating or as fuels; and lastly, third, when the excisable goods are released for the consumption or used for own use. Next is plastic tax and sugar tax. The 2020 budget law introduced a new tax on the utilization, even partial, of single-use plastic items, or MAXC, which have or are intended to have the function of containing, protecting, handling, or delivering goods or food products, even in sheet, film, or strip shape. The 2020 budget law also introduced a new tax on sweetened beverages. Notably, the tax applies to finished products and those prepared to be used as such after dilution, falling with the headings of NC 2009, fruit juices, vegetables, and legumes, and 2202, or water with added sugar or other sweeteners or flavoring, and other non-alcoholic beverages of the European Union combined nomenclature, put up for sale, intended for human food consumption, obtained by adding sweeteners and having an alcoholic strength of less than or equal 1.2% by volume. Next is the CBAM, or the Carbon Border Adjustment Mechanism. Starting on October 1st, 2023, the CBAM applies to import of the following product groups to the European Union from non-European countries: first, aluminum, iron and steel, fertilizers, hydrogen, electricity, cement. Next, the CBAM does not apply to goods originating in the following countries: Iceland, Liechtenstein, Norway, and Switzerland. Next is stamp duty taxes. Stamp duty tax is usually alternative to VAT. However, in case of considerations partially subject to VAT and partially not subject to VAT, the invoice is subject to stamp duty tax if the total amount of the considerations not subject to VAT exceeds 77.47 euros. Moreover, some actions are stamp duty tax exempted. And for transactions out of scope VAT exceeding 77.47 euro, an amount of 2 euro is due as stamp duty tax for each issued invoice. Next is the Unified Municipal Tax, or the Imposta Unica Comunal, or IUC. The IUC is composed of the following different taxes: Imposta Municipal Unica, or the real estate levied on the ownership of the immovable properties such as buildings, rural land, farmlands, except for immovable properties owned as primary private properties. Next is the Tributo per Servizi Indivisibili, TASI. It is a service tax due by real estate owners and by tenants except for immovable properties aimed as private properties. This is different from immovable properties falling under the cadastral category. Lastly, the tassa su refuti, or the tari. This is a waste tax levied on the owner or the user of immovable properties. Next is the financial transaction tax, or FTT. Italian FTT applies to first, cash equities; second, derivatives; and third, high-frequency trading transactions. Next is the digital service tax. The web is addressed to taxpayers who individually or at the group level realize during a taxable year or calendar year a total amount of worldwide revenues exceeding 750 million and a total amount of revenues realized in the Italian territory exceeding 5.5 million euros. Next, the collected revenues are taxable when the user uses the device to access the above digital services in Italian territory. In order to identify the location of the user, the Italian tax authority has provided specific linking rules between the user and the Italian territory. For example, the IP address or by other means of geolocalization. Lastly, the Social Security contributions. The total security rate is around 40% of the employee's gross compensation, or the rate depends on the work activity performed by the company, the number of employees of the company, and the employee's position, and is shared as follows. First, employer's charge is around 30%, and employee's charge is around 10%. Now, let's talk about the branch income. The tax regime for PEs is the same as for corporate Italian entities. For example, joint stock companies. Accordingly, a PE is subject to IRS as well as to IRAP. Both taxes are determined on the basis of a specific statutory account prepared according to the accounting principles applying to resident enterprises with similar business activity carried out by the PE. For IRS, the maximum depreciation rates for fixed tangible assets are set forth in a ministerial decree. Such depreciation rates are different depending on the type of asset and on the economic sector in which the company operates. In the event that financial accounting depreciation exceeds the amounts allowed for tax purposes, temporary differences arises. Tax depreciation of fixed tangible assets is allowed from the tax period in which the asset is first used.
Income determination. IRS income determination, they have specific rules that have been released for entities adopting Italian generally accepted accounting principles, rather than international financial reporting standards for Italian statutory financial reporting purposes. These provisions are aimed to align the taxable basis determination rules with the statutory financial reporting. And for that reason, the taxable basis is influenced by the qualification criteria, time-based recognition, and classification in the financial statements provided by the related accounting standards. There are also measures aimed at coordinating different items of the tax code in the light of new evaluation and representation criteria introduced by the accounting reform. IRAP income determination. Ang mga importante lamang na income at its IRAP income determination. Dito, ang mga importante lamang na income at expenses ay yung mga na-report sa kanilang required or statutory financial statement. The positive and negative items resulting from the transfer of business concern ay hindi nakabilang sa sakop ng taxable basis. Inventory valuation. Companies operating in the oil and gas sector are required to adopt either average cost of FIFO or first in, first out for tax purposes. The 2024 budget law in Italy has introduced the option for the OIC adopters in ordinary accounting to adjust inventories to the actual inventory situation for the tax period in progress to September 30, 2023. The adjustments entails the payment of a substitute tax for IRF-PEF or RL. The adjustment entails the payment of a substitute tax for IRPEF, IRIS, and IRAP at the rate of 18%. In case of elimination of an inventory in respect of the opening balance, in addition to the 18% substitute tax, but is also due. The choice must be made in the tax return related to fiscal year in progress at September 30, 2023. Capital gains. In capital gains fixed assets, the gain realized on the sale of fixed assets is taxable for both IRS and IRA purposes. Additionally, for IRS purposes, tax on capital gains can be spread over a maximum of 5 years. This treatment is allowed if the company owned the fixed asset for not less than 3 years. And in their financial investments, a specific participation exemption regime is applicable. Under this regime, capital gains realized by Italian companies on sales of shareholdings are 95% exempt from IRS. Dividend income. Conversely, no exemption applies to dividends paid by entities that are resident in tax havens jurisdiction. Dividend income. Conversely, no exemption applies to dividend paid by the entities that are resident in tax haven jurisdictions. There are also specific rules for entities adopting IFRS for Italian statutory financial reporting purposes. Although for such entities, dividends from investment in shares and other financial instruments held for trading are fully taxable. And interest income, unfortunately, interest income is generally part of the taxable base. So we'll continue to the waiver of credits. Here in waiver of credits, a specific regime is applicable regarding the waiver of credits. Example of these are the financial or the commercials. Towards the company by its shareholder. In particular, the part that exceeds the tax value of the credit is considered taxable income. Furthermore, the shareholder is required to provide a statement to the company pointing out the tax value of the credit. Without such a statement, the company will have to tax the full amount of the waiver of the credit. Foreign income. Ang isang Italian resident corporation ay taxable sa lahat ng income maging sa Italy o sa ibang bansa. Ang mga income na kinita ng mga subsidiary na naninirahan sa bansa o teritoryo maliban sa mga tax haven are only taxable on distribution of the relevant profits. Reshoring of business or professional activities. Pending approval from the European Commission, a proposed 50% reduction in corporate income tax and IRA tax is allowed for business and professional income transferred to Italy from a non-UE or EEA country for at least 6 fiscal years, unless the transferred activities had been carried on in Italy in the 24 months preceding the transfer. And lastly, the shell companies. Resident companies and PEs of non-resident companies can be qualified as non-operating entities if the average revenues recorded in the current fiscal year and in the prior 2 years are lower than the amount resulting by applying certain deemed return percentages to the average balance sheet value of specific assets in the current fiscal year and the 2 previous years. Here, the main assets to be taken into consideration are shares and shareholdings, financial receivables, owned or leased real estate, and owned or leased tangible and intangible assets. The value of any assets acquired or sold during the fiscal year must be adjusted according to the ownership period. These conditions must be checked every year dahil may posibilidad ang entity na maging non-operative in 1 year at maging operative uli the following year.
Now, let's proceed with deductions. Depreciation and amortization. The maximum depreciation rates for fixed tangible assets are set forth in a ministerial decree. Such depreciation rates are different depending on the type of asset and on the economic sector in which the company operates. In the event that financial accounting depreciation exceeds the amounts allowed for tax purposes, temporary differences arises. Tax depreciation of fixed tangible assets is allowed from the tax period in which the asset is first used. Next, superdeduction for new hires. For the only fiscal year following the one in progress on December 31, 2023, companies hiring permanent employees will benefit at certain conditions of a 20% increase in the personal cost deduction. Next is finance leasing. Leasing expenses booked in the profit and loss statement pursuant to Italian GAAP are fully deductible from the IRS taxable base if the relevant agreement has a minimum duration period. Next is the interest expense. Net interest expense in excess of the yearly limitation is carried forward in the following fiscal years. Hence, net interest expense not deducted in previous years can be deducted in the future fiscal years as long as total interest in that year does not exceed 30% of gross operating margin. Next is the allowance for corporate equity, or ACE, deduction. ACE was a deduction equal to the net increase in the equity employed multiplied by a rate determined each year. This rate was equal to 1.3% from fiscal year 2019. Next is bad debts. Losses on bad debts shall be deductible if supported by precise and objective elements, or in any case, if the debtor is subject to bankruptcy proceedings, including foreign ones. Next is the charitable contributions. Deductions of charitable contributions is allowed. The amounts allowed for deductions depend on the specific features of the recipient entity, and the specific limitations are set by the law. Next, entertainment expenses. Expenses for gifts and entertainment that meet the requirements, both qualitative and quantitative, contained in the specific ministerial decree are fully deductible in a tax period in which they are incurred. Entertainment expenses that do not meet these requirements cannot be deducted. Next is the meals and lodging expenses. The deduction for meals and lodging expenses incurred within the municipality is limited to 75% of the amount incurred. However, the VAT related to such costs is fully recoverable. Next, car costs. Car costs may be entirely deductible if, first, automobiles are absolutely necessary for the company's business, or second, automobiles are an essential element in the company's activity. Next is telephone expenses. For IRS purposes, up to 80% of the total expenses related to both mobile and landline telephones are deductible. Next is the fines and penalties. Fines are generally not considered inherent costs and are consequently not deductible for tax purposes. Next is taxes. IMU is deductible for IRS purposes up to 100% of the amount paid in fiscal year 2022 and in the following fiscal years. Previously, it was deductible up to 50% of the amount paid in fiscal year 2019 and 60% of the amount paid in fiscal year 2020 and fiscal year 2021. Next is the net operating losses. Tax losses can only be offset with a taxable income for an amount not exceeding 80% of the taxable income. Thus, corporations are required to pay IRS on at least 20% of taxable income. Next is the payment to foreign affiliates. Transaction with foreign affiliated companies should be at fair market value and generally as a defined by OECD guidelines. And lastly, deduction of costs suffered for transactions with non-cooperative jurisdiction. Expenses borne for transactions with entities resident or located in non-cooperative tax jurisdictions are deductible for CIT purposes within the limit of their fair market value unless actual evidence of their economic soundness and effective execution is provided to the tax authorities.
Group taxation. The group taxation in Italy have domestic tax consolidation, global minimum tax, worldwide tax consolidation group, transfer pricing, country by country reporting, tin capitalization, and lastly, the controlled foreign companies. And I will be starting with the domestic tax consolidation. In tax in domestic In domestic tax consolidation, the tax consolidation does not operate for IRA purposes. Where an overall tax loss positions arises, this can be carried forward and used against future consolidated taxable income. The consolidation arrangement operates on an elective basis. Taxpayers may select whether to be included or not, and it is not necessary for all the Italian groups or subgroups companies to jointly elect for the tax consolidation. Global minimum tax. Here I will discuss three topics that is under the global minimum tax. First, Income Inclusion Rule or IIR. The decree provides for a IIR applicable to parents, ultimately parent entity, intermediate parent entity, or partially owned parent entity located in Italy with respect to foreign located and stateless law tax constituent entities. The decree also provides for a domestic IIR applicable under the rule order by an Italian parent or itself and to Italian located constituent entities that are LTCE or the low tax constituent entities. Second, under tax profits rule or UTPR. The decree, in line with the GLOBE rules and the directive, provides for the UTPR as a separate charging provisions. Here, the decree in line with the GLOBE rules and directive provides for the UTPR as a separate charging provisions. And lastly, the Qualified Domestic Minimum Top-Up Tax or QDMTT. The Qualified Domestic Minimum Top-Up Tax will be applicable for fiscal years that begin on or after December 31, 2023. The same is provided for the multinational groups in the initial phase of internationalization and for large-scale domestic groups. As regards the accounting standards, the decree adopts the local accounting standards with the UPS accounting standard as a last resort rule. Worldwide tax consolidation. In addition to the requirements set out of the domestic tax group system, they must meet the two applied conditions, which are number 1, the ultimate parent company must be either owned by the individuals who are tax residents of Italy or listed on the Italian Stock Exchange. Second is the option that must be exercised for all foreign companies under the all-in, all-out principle. And let's go for the transfer pricing. Income derived from the operations with non-resident corporations that directly or indirectly control the Italian entity are controlled by the Italian entity and let's go for transfer pricing. Income derived from the operations with non-resident corporations that directly or indirectly control the Italian entity are controlled by the Italian entity or are controlled by the same corporation controlling the Italian entity have to be valued on the basis of the arm's length nature of the goods transferred, services rendered, and services and goods received if an increase in taxable income is derived therefrom. Penalty protection regime with the transfer pricing documentation support applies to transactions incurred between Italian entities and non-resident entities belonging to the same group. Note that transfer pricing rules are not applicable to domestic transactions. Transfer pricing documentation must be prepared each year on a company-by-company basis. Small and medium companies can update the economic analysis only every 3 years, provided that the comparability analysis is based on publicly available sources and no significant change between the fiscal year have occurred. And in advanced pricing arrangement, the procedure is available for companies engaged in international activity and can cover transfer pricing issues, allocation of profit to PEs, dividends, and the existence or otherwise of an Italian PE royalties and interest. Country by country reporting, or CBC. CBC reporting has been introduced in Italy for MNE groups with a consolidated group revenues of at least 750 million euro. And with this report, any MNE group shall disclose annually and for each tax jurisdiction in which it conducts business and information set out therein. Penalties are Penalties are levied in case of miss or untrue communication. Penalties can range from 10,000 euro to 50,000 euro. And for tin capitalization, Italy no longer has tin capitalization rule per SE. Instead, net interest expense is deductible only up to an amount equal to 30% of gross operating margin. And lastly, the controlled foreign companies or the CFCs. An Italian company that controls either directly or indirectly foreign enterprises, company or other entity is required to consolidate the taxable income arising in proportionate to the percentage of shareholding held, irrespective of whether the profits have been distributed or not.
Now let's discuss with tax credits and incentives. Let's begin with foreign tax credit. Foreign source income definitively is taxed abroad. A tax credit can be claimed for use against a company IRS liability. The amount of the tax credit that can be claimed is the lower of the foreign tax incurred and the proportion of the IRS liability related to the foreign source income. For partially exempt income, the foreign tax credit is reduced in proportion to the amount of income taxable in Italy. Next is the introduction of the reshoring exemption. The tax period in which the reshoring takes place, and in the 5 subsequent tax period, a 50% exemption for CIT and regional tax purposes is granted for income deriving from the repatriated assets and activities. Next is the tax credit for investment in new capital assets. Here, all enterprises can benefit from the tax credit for investments in new capital assets regardless of the legal form, the economic sector in which they operate, the size, and the regime applied for income determination. Let's discuss as well the tax credit on investment in research and development or the technological innovation and design and aesthetic ideation common rules. First, R&D tax credit. For the R&D tax credit, in line with the legislation in force until December 31, 2019, the eligible activities consist of fundamental research, industrial research, and experimental development as defined, respectively. Next is the tax credit for technological and digital innovation and ecological transition. Tax credit is equal to 10% of the eligible costs incurred with a maximum annual amount of 2 million euros. The applicable rate is increased to 15% in case the eligible activities consist of technological innovation aimed to reach an ecological transition goal or a digital innovation goal compliant with the so-called 4.0 model without prejudge of the maximum annual amount of 2 million euro. Next is the tax credit for design and aesthetic ideation. This measure is addressed mainly to enterprise operating in the textile and fashion, footwear, eyewear, gold, furniture, and ceramic sectors that have carried out design and aesthetic ideation activities for the conception and realization of new products and samples. Next is the tax credit for investment in Southern Italy Special Economic Zone. The tax credit will be recognized in a variable amount depending on the size of the company and the location of the investment made in the regions of Southern Italy, which become a single special economic zone, relating to the purchase of new capital goods, such as plants, equipment, and machinery, and the purchase of land and the construction of buildings. Next is the advertising campaign tax credit. It is a facilitative measure intended for businesses, self-employed workers, and commercial entities in relation to investments made in advertising campaigns in the daily and periodical press, including online. Next is the old patent box regime. Law number 190 dated December 20, 2014, Italian resident companies and PEs of non-resident entities that carry out R&D activity either directly or by outsourcing it to the universities or other research institutes or equivalent institutes may elect to apply the Italian patent box regime. The regime exempts a portion of the income derived from the exploitation, either directly or by licensing of qualifying intangible assets. Taxpayers must request a specific ruling from the Italian tax authorities to benefit from the regime when the qualifying intangible is used directly by the company. The ruling is optional where the qualifying intangible license is to a related party. Lastly, new patent box regime. Here, Law Decree number 146 issued on October 21, 2021 as amended by the 2022 Budget Law has revised the previous patent box regime with effect from 2021 by shifting from a profit-based incentive to a cost-based incentive. In order to benefit from this new procedure, each year taxpayers have to opt for it in the annual CIT return and prepare a proper documentation set whose possession has to be declared in the annual CIT return.
Withholding taxes. Here in our PPT, you can see the chart of withholding taxes. A 26% base standard withholding tax rate applies on the yields on loans and securities. Examples of these are the bonds, shares, and etc. Paid by the Italian resident entities to both Italian and non-Italian resident investors. The standard withholding tax rate, however, may be reduced under the applicable DTTS or EU directives or other special domestic tax regimes, such as withholding tax exemptions and reductions are only granted to the beneficial owner of the income. Interest on government bonds is subject to a 12.5% domestic withholding tax.
Now let's talk about tax administration. So first, taxable period. In particular cases, the duration of the taxable period can be different from 12 months. For example, newly established companies may be allowed to have taxable periods of up to 18 months. Companies that are involved in extraordinary transactions, such as mergers, demergers, or etc., as well as companies that are liquidated, may have taxable periods shorter than 12 months. Next, tax returns. As a general rule, IRS and IRAP returns must be filed by the end of the 9th month following the tax year end. Tax returns relating to the tax period preceding the one in progress on December 31, 2023, expiring after May 2, 2024, should be submitted according to the previous deadline. Next is the payment of taxes. The tax law provides for both advance payments and the settlement payments. As a general rule, the advance payments are equal to the net tax liability for the previous tax period and are due during the tax period to which they refer. The advance payments due are equal to 100%. So, offsetting of taxes, payables and receivables, not claimed for refund, resulting from a return regarding different taxes are allowed for offsetting within a yearly limit of 2 million euros. Next is the administrative penalties. Here, failure to file tax returns result in a penalty ranging from 120% to 240% of the taxes due. Minimum penalties ranging from 250 euros to 1,000 euros are applicable if no tax liability emerged in the return. Next, synthetic index of tax reliability or ISA. The ISA represents an economic and statistical methodology to determine the level of the tax reliability of the taxpayers. A low level of reliability will increase the risk to be included in the list used by the tax authorities in order to select the taxpayers to be audited. Next is tax ruling. The tax authorities must admit through the procedure within 30 days from the receipt of the instance. However, tacit acceptance from the tax authorities applies. The procedure that involves a contradictory procedure between the tax authorities and the taxpayer ends within 180 days from the receipt of the instance. In particular, for those enterprises that intend to make new investments in Italy for a value not lower than 15 million euro, a ruling on new investments could be filed disclosing tax treatment of the investment and all related extraordinary transactions. Next is the tax audit process. Here, tax audit can take place at taxpayers' premises as well as in the tax authorities' offices. The statute limitations provides the tax auditor can stay at the taxpayer premises for not longer than 60 working days. Next is tax controversy and dispute resolutions. In case no settlement is either achieved or requested for, taxpayer may start a tax dispute before the court. The judicial proceedings are structured in 3 tiers: tax court in first instance, tax court in second instance, and Supreme Court for cassation. Next is the statute of limitations. The Italian tax authorities are entitled to make an assessment in relation to corporate taxes, IRAS and IRA, VAT, and withholding tax returns up to the end of the 5th calendar year following the year in which the tax return was filed, up to the end of the 4th calendar year, or the end of 7th calendar year following the year in which the tax return would have been filed for an omitted return, up to the end of 5th calendar year. Next is topics of focus for tax authorities. Extraordinary transactions such as mergers, demergers, etc. continue to be a topic of focus for tax authorities due to the potential applicability of tax anti-abuse rules. The beneficial ownership condition is very carefully scrutinized in case of payments where a nil or reduced withholding tax is applied based on European Union directive or applicable DTT, in particular when the ultimate owner of the group is non-European. Next is the Tax Control Framework, or TCF, and Cooperative Compliance Regime, with the approval of the Law Number 111 of 2023 for the reform of the tax system, and with the enactment of the Legislative Decree Number 221 2023 for Cooperative Compliance Regime has granted additional certainty to companies that intend to invest in transparency towards the tax authorities. First, significant key reduction of the assessment terms. Second, enhanced reward on the level of penalty system for taxpayers who applied the regime up to the disapplication for both the administrative penalties and the criminal penalties. Next is the tax offenses and the entity's criminal liability, the rules as per Decree 231 of 2001. With the fiscal decree linked to the Budget Act, Decree Law Number 123 converted into Law Number 157 of 2019 on urgent provision on tax matters and urgent matters that cannot be postponed. A significant part of the tax crimes attributable to tax fraud entered the catalogs of offenses for the liability of entities for administrative offenses governed by Legislative Decree Number 231 of 2001. Next is the mandatory automatic exchange of information in the field of taxation in relation to reportable cross-border arrangements, or the so-called DAC6. DAC6 requires intermediaries and taxpayers to promptly communicate to the tax authorities of the member state of tax residency, establishment, or in which they operate the cross-border arrangement subject to the reporting obligation, or the reportable cross-border arrangement, or RCBA, when certain conditions are met. In this regard, from an objective point of view, two elements are relevant. First, the presence of a cross-border element, and second, the presence of the least one of the hallmarks in the arrangement, so that it is considered to be subject to the reporting obligation. Such hallmarks are listed in the Annex 4 of DAC 6.
Other issues. Adoption of IFRS in taxation. For IAS or IFRS adopters, The Italian tax law provides for the enhanced derivation of the CIT basis from the IFRS statutory financial statements. The taxable base is determined starting from the net income arising from the profit and loss. Increase or decrease by items directly booked equity pursuant to the applications of IAS or IFRS. In this respect, the accrual principle in the qualification and classification criteria stated by the IFRS are relevant for the calculation of the taxable base. Valuations criteria are not accepted for tax purposes. Specifications and limitations of the derivations principle can be introduced by means of a decree issued by the Ministry of Finance. And here are the listed specific rules applicable to IAS adopters that must be considered. Foreign Account Tax Compliance Act or FATCA and Common Reporting Standard or CRS. The FATCA or FATCA aims to detect and discourage offshore tax evasion by United States citizens or residents for tax purposes in the United States who hold financial assets through foreign financial institutions. Generally, banks, custodial institutions, certain investment entities, and life insurance companies. The CRS or the Common Reporting Standard Decree includes the Annex C, which lists the reportable jurisdiction. Example of this is each European Union member state that is not Italy and each jurisdiction that has signed an agreement with Italy or with European Union on the basis of which it would receive information in reportable accounts. And Annex D, which lists the participating jurisdiction. For example, each European Union member state that is not Italy and each jurisdiction that has signed an agreement with Italy or with European Union on the basis of which it would transmit information on reportable accounts. And here ends our reporting in taxation on corporate in Italy. Once again, I am Alexandra Garcia,
And I am Nicole Bonok.
and we are your delighted reporters for this topic. Thank you for listening.